All right. I'm here.
Okay.
All righty. So chapter 7. Oh, and also Frank, if at any time you can't hear me, just let me know. Hold on.
Okay.
Plastic shields and everything in front of me. That should be better. Okay. So chapter 7, we're doing the first 3 learning objectives. So we're looking at investments. Specifically, we'll be looking at how we treat interest, how we tax it, how we tax dividends, what they are and how we tax them, and then capital gains. Capital gains are the real meat and potatoes of this chapter. They're the more complex end of it because there's all different kind of scenarios that could occur when we sell capital assets. So we're going to focus on that part of our discussion on Friday. And from the looks of it, I think we'll probably be doing Zoom unless more people come back to class. But I think even if we have more people in class, I'm going to try to do what I'm doing today, record it and also have a live class. Okay, so some important things to remember when we are looking at going into an investment. And what we're talking about here is, should we buy this corporate bond or should we buy this municipality bond? There is 2 different types of returns on investments. There's a before tax and an after tax. So I'll show you that in a second. And what each is depends on when the investment income is taxed on that item. And then also what these returns are depends on the rate at which the income is taxed. So let me just show you a quick example here. You have a marker that works and you'll be able to see it, Frank. You know what I'm going to do? I'm going to go into a Word document instead of writing it on the board so that you can see the information. Even Excel, even better. Okay, so let's say you have the opportunity to purchase a $100,000 IBM bond that pays interest at 8% annually. Now, just to review, remember, a bond is when the taxpayer basically loans money to the selling corporation or government agency. The corporation in this case promises 2 things to the bondholder, the purchaser of the bond. They promise to pay them interest at certain time periods. This one will be annually. And then they'll pay back the principal at the end when it matures. So that's how a bond works. But it's basically when the person purchases the bond, they're loaning money to the corporation or the government. And then they'll get their money back when it matures. Well, if this person's marginal tax rate, remember marginal, it's the next dollar of income, what will it be taxed at? Is, get them at the top of my head, I think 22% is one of them. 22%. Their before tax return on investment would be the interest income itself, the 100,000 times 8%, or $8,000. That's how much interest income, that bond earned. And that's how much the bond holder receives this year. Well, interest income is taxed at ordinary tax rates. So this interest would be subject to a 22% tax rate. So 8,000 times 22%. This taxpayer is actually going to include this on their tax return and end up paying $1,760. I'm going to put that in as a minus so we know it's subtracted, of tax on this. So they receive cash of 8,000, but then they have to pay cash of $1,760 for the taxes. So their after-tax return on investment is the difference. So 6,240. So if we wanted to calculate, well, what was their real return on investment? We would take the interest of 8,000 divided by what they paid for this, and we're going to assume they paid 100,000. So it would be 8%. That's how much they earned on that $100,000. But that's before tax. What is their actual or after-tax return on investment? We'll take the net after they pay taxes on that 8,000 divided by the original investment. So we're looking here at 6.25%. So this is their real return on investment, not the 8%, because they have to pay that income tax. And that's really important when we're deciding what to invest in. Because what if they could have taken that $100,000 and purchased a Luzerne County bond that pays 7% annually? If they didn't look at this after-tax return on investment and they just looked at that 8%, they may say, oh, we're gonna buy that bond at 8%. It pays more annually than the Luzerne County bond. That may be true, but the before and after tax return on investment for the Luzerne County bond, remember, would be 7%, because there is no tax on the interest income related to a state or municipal bond. So that's what they're talking about in that slide. Be careful. Make sure you choose your investments wisely and take into account any kind of tax that may need to be paid on that income. So you're truly receiving what you want or the best return. You guys have any questions on that? All right, let's go back over there. The last bullet there, these last two bullets is portfolio versus passive investments. We're going to kind of ignore this word passive right now. We're going to come back to it later. What's important to remember is that when you have investments in stocks, bonds, certificates of deposits, savings account, non-business, Okay, so it's not a partnership. Okay, it's not a sole proprietorship. These are called portfolio gains and losses. And you might hear somebody say, well, what's your investment portfolio look like? That's why we call it portfolio income. So if you hear that term, that's what we're talking about. What's important is that portfolio losses, and we'll see this later in the chapter, we don't recognize losses until we actually sell it and sell it for a loss. So it's just saying, if that investment goes up or down in value in the world, we ignore it until we actually sell it. And we already know that, but you remind us about it. All right, so let's get into talking about some of these portfolio incomes. And today our focus is on interest and dividends. Some of it is kind of self-explanatory. You're like, well, I already saw some of this. We're going to review it. We're going to show you the 1099s that go with these different types of incomes, what you would see as a tax preparer. And you'll see these on your tax project. So that's why I like to review them. What's important to remember is that when it comes to interest and dividends, you usually pay tax on them when you receive it into the account. So you don't have to withdraw it as cash, and we talked about that. That's called that constructive receipt doctrine. You have the availability of it, you have access to it, you just choose not to take the money out. So you've constructively received interest, whether you have the cash or not. So common interest income items, we just saw one, are bonds. So when a taxpayer purchases a bond, it could be a government bond, it could be a corporate bond, interest income must be recognized on it. CDs are certificates of deposits. Certificates of deposits. And if you're not familiar with those, they're usually contracts you purchase from a bank. And the key difference between a certificate of deposit and a savings account is that you have to leave your money in the certificate of deposit for a certain period of time. So the bank usually pays interest rates on that money based on the period of time they could keep your money. So a 6-month certificate of deposit will normally have a lower interest rate than a year certificate of deposit or a 3-year certificate of deposit. But they're just like a savings account that earns interest, but they're restricted. You can't touch the money in them until that contract matures. As you're earning the money on the interest income on certificates of deposit, it will be included as taxable income. Savings accounts work the same way, but the interest on that, well, that's recognized in the year that it's put into the savings account, but you could take your money out at any time out of a savings account. It's not restricted normally. Any questions on any of those? Pretty straightforward. I think we might be familiar with them. What's important to remember is that interest is taxed at ordinary rates, except for our state and municipal bonds. Remember, they're tax-free. Something else to remember, and this is true for the state of Pennsylvania, this is not for federal purposes, but if you cash in a US Treasury bond, that's one of those bonds that you buy at the bank for $25 and then you cash it in 10 years later for $50. That $25 difference is interest income. So the difference between what you originally paid for it and what it matures at is interest income. That's taxed for federal purposes, but states don't. And they just tell you that. I mean, we're not doing states tax returns, but just so you know that. I know there's some more stuff I want to talk about. So that's just a quick overview on interest. Let's talk about some more details. And before I get into more details, I want to pull up the 1099 INT so you can see it. I can't remember if they have it in your book. No, okay. So let me just end this. Go to the IRS's website. And I want to talk about the form we use to report interest income if it reaches a certain level. So this is a 1099 INT, a little bigger there. Okay, and this is what the payer of interest will send to the taxpayer. So the bank or the corporation, the government, it all depends on who is paying the money to the taxpayer. So they'll say who paid it, and then the taxpayer's name and social security number. But the most important box here is box 1, interest income, because that's the amount that's reported on the 1040. And we'll pull that 1040 up just to remind you where it goes. We do report interest on US savings bonds so that you as a tax preparer knows, hey, when I do the state tax return, I don't have to report that as income. There's other items on here that are 1 or 2 we talk about. Here's one, 8, tax exempt interest. So if the taxpayer receives any tax exempt interest, box 8, remember that does get reported on the 1040. Another important item here is number 2. It's called early withdrawal penalty. So let's talk about that for a second. Remember we talked about certificates of deposits, and we said, hey, when you have a certificate of deposit, you're required to keep that money in that account for, if let's say it's a 1-year certificate of deposit. Well, let's say 9 months in, you're like, I need that money. Well, the bank can't say to you, nope, you can't have it. So they will give you your money, but usually they penalize you for taking your money out early. And different banks have different penalties, but most of the time it's the interest that was earned on it. Now, I know you're going to think this is weird, but this is what happens. Even though you don't get that interest, it's still reported as if you did. You earned that. But then the bank penalized you. So you will report the interest earned on that CD, even though you didn't receive it, as interest income. But you're allowed to deduct the portion that was a penalty you never received as an early withdrawal penalty. And I'll show you that on the 1040. You guys cool with that? All right. So let me pull up a 1040 here. And we'll look at that, and then we're going to look at the Schedule B. So here's our 1040. We'll focus in where we worry about interest. There it is. 2A is where we'll report all the tax exempt interest. So a taxpayer will receive a 1099 for each different bank, bond, etc. So a taxpayer could have a lot more than 1 or 2 1099 INTs. As a tax preparer, we add up all of the box 8s and report it on line 2A. We do the same thing with all the box 1s on all of the 1099 INTs, and we report it on 2B. Now, if the total interest income overall is more than $1,500 for the year, a taxpayer is required to complete a Schedule B. you'll be doing this for your project. So let's take a look at that. Just want to keep them separately. Okay. So you can see it says Schedule B, interest and ordinary dividends. So we not only report interest income on here, we also report dividend income. And all we're doing here is, because our interest income is so high, the IRS wants us to list each separate 1099 INT payer amount. So payer identification. So if your, US Bank is one of the 1099 INTs who paid interest income to the taxpayer, you'll put US Bank and then their box one amount. So we're reporting those 1099 INTs separately on this form. And then we total them up at the bottom. I'll talk about line 3 in a second. We talked already a little bit about it. Okay? So that's usually around a $1,500 amount. And then if you do have more than $1,500, you are required by law to finish part 3 about foreign accounts and trusts. And this is even more important since 9/11 than it was before 9/11. They want that completed. You have to answer those questions honestly. And if you're not sure, you find out from the taxpayer and document. You could get in trouble as a tax preparer for not completing it. Okay, so if you are required to fill out Schedule B for interest income, you can see in line 4, it says, enter the result here from your calculation up here and on form 1040, line 2B and right here. And then you would attach this schedule to the 1040. The other thing is that early withdrawal penalty. Where does that go? Well, if you remember our tax formula, it's a take gross income, subtract deductions for adjusted gross income, which is, these appear on Schedule 1, Part 2. And there it is, line 17 is a deduction for adjusted gross income. You put it on line 17, penalty on early withdrawal of savings, and you would subtract it. So that's where that would be reported. Any questions? Okay. So I want to hit on 1 or 2 more things. One more form, let me grab my glasses. And these are on page 7.3 to 7.4. We're not going to get too crazy talking about discount and premium on bonds, but we are going to talk a little bit about discount. I'm going to come back over here. Now, there's something, and this is on the bottom of page 7-3, and it's called original issue discount. And we're not going to get into the whys, that's for another class. But sometimes when a bondholder buys a bond for the first time from a company, they may not pay the principal. So let's say we have taxpayer A purchases a $100,000 bond from IBM that pays 8% interest for $98,000. So the principal, or what they're going to be paid back at the time this bond matures, is $100,000. But for reasons due to the market, and that's what we'll leave it at, this bondholder only has to pay or loan the company $98,000 today. So that difference between the purchase price of the bond, which would be $98,000, and the principal, what the corporation promises to pay back, is called discount. So when this bondholder purchased this bond from the corporation, they purchased it at a $2,000 discount, original issue discount. When a bond is sold like that, the corporation is required to report to the taxpayer the portion of the discount that must be recognized as interest income, because that's really what this is. But instead of this bondholder receiving this $2,000 over the life of the bond, they receive it all at once when the bond matures. So they pay less upfront, but that difference between what they pay now and what they get later is really interest income to the bondholder. Trust me on that. It's interest income. And it's recognized over the time period of the bond. So the corporation will report to the taxpayer, hey, you know that discount we gave you? Here's how much you have to recognize this year as interest income. And we call that original issue discount. The corporation reports that on a special 1099 to the bondholder, to the taxpayer, and it's called a 1099 OID. I'll pull that form up so you can see it. So not only will you use your INT, but your OID if the taxpayer has one. Go into the about. And it's pretty straightforward. It's a lot like your 1099 INT. So there is the corporation, the recipient, so the taxpayer's information here. And there's line 1, original issue discount for the year, or box 1, I should say. That gets added with your 1099 INT amounts. Other stuff on here you'll learn in practice, okay? But that's what I wanted to focus on there and show you that there are forms for the interest income that you must report related to receiving a discount when you buy a bond, and that's the only time. For our purposes, and then interest income 1099 INT. Those are your 2 major forms and where they get reported. Questions? Cool. One last thing about interest relates to U.S. savings bonds. Well, actually 2 things. U.S. savings bonds, first of all, you have a choice as a taxpayer when to report interest income. You can either 1, report the interest income in the year of redemption, So when you turn in that savings bond and get your cash, remember, those are the bonds, you go to the bank, you say, I want a $100 bond, and they go, okay, pay $50 today, and in 10 years, we'll give you 100. Well, in 10 years, when you redeem that, you would report the other $50 as interest income, because you only paid $50 for it. It's not considered a capital gain, it's considered interest income. Or you can determine the amount of interest earned each year on the savings bond and report it each year. Well, once you pick that choice, you have to do it for all your bonds. So it's basically like we do in financial accounting, where you say, well, how much interest was earned this year on the bond? Okay, that's how much interest income I'll recognize this year, even though I didn't redeem it yet. Because then when I do redeem it in that final year, I'll just have to show the amount of interest from that year on my tax return instead of all of the years like I would with step one or my choice one. That's the first thing. The other thing with US savings bond, and we touched on this a little bit, is that if US savings bonds are redeemed and used to fund higher education, tuition, fees, supplies, books, the taxpayer may be able to exclude the interest income from their tax return. So if the owner of the US savings bond goes and cashes it in and uses it to pay for tuition, fees, supplies, or books, the taxpayer who cashed it in and owned it and has to include that interest income on their tax return may be able to exclude all or a portion of that from being taxed as interest income. But there's one or two major rules they have to follow. The owner of the savings bond must have been at least 23 years old when the bond was purchased. They had to be 23 years old when that bond was purchased. So the person's name on that savings bond. 2, the bond was purchased after 1989. So if the bond was purchased before 1989, it's not included for these purposes. It's usually step 1 there, requirement 1, that throws people out of eligibility for this. Let's say, like my mom does, okay, or I've done this too. I buy US savings bond for my son when he was 3 years old. And usually people buy them to say, oh, use these for your education when you're older, right? Well, if I put his name as the owner of the bond, this doesn't apply to him because he wasn't 23 years old when that bond was purchased. In order to qualify, I have to buy the bond and put it in my name. Then I have to cash it in and pay for higher education with it. And that's okay. I would qualify then because I was at least 23 years old, assuming I was at least 23 years old, but I was 33 when I had my son. So 23 years old when the bond was purchased, and it was purchased after 1989. If I cashed it in now and paid for his tuition fees, supplies, and books, I may qualify to exclude the interest income from that. So that's key there. And that's usually where people get upset because they're like, whose name was the bond in? And they say they're kids, and I'm like, you're not qualified for this then, because of that. Any questions? So coming back over to the Schedule B, if you are eligible to exclude any of that interest, okay, you include it up here as if it is includable, and then you subtract it on line 3. And you also have to fill out a special form called an 8815 to do all the detailed calculations to show, hey, I actually am eligible to exclude this. We're not going to get into that form, but I just wanted to show you that. You would include it up in the top, subtract it from line 3 to get your actual taxable amount of interest. Any questions? All right, let's then talk about dividends. Okay. What's important to remember is that most dividends, it's not on this slide, but most dividends are ordinary dividends. Let me do this. Let me get out of the slide and define a couple things for you when it comes to payments from corporations. Payments to shareholders from corporations. Ordinary dividends, which are most payments, are when the corporation pays the shareholder from the profits of the company, or what we in accounting call retained earnings. So anytime payments are paid to the owner from the profits of the company, we call them ordinary dividends. Sometimes, though, corporations will pay from other parts of equity. And these are called non-taxable distributions, or they'll call them non-dividend distributions. And this is when a corporation pays the shareholder from additional paid-in capital. Whoa, I think I've seen this item before, but I forget what it is. Additional paid-in capital is that account where we store the amount of money the corporation receives from the shareholder that was above the par value of the stock. So if a company sells stock for above its par value, the excess above par value was stored in this account, additional paid-in capital. Some states let corporations pay money to shareholders out of this account. And this usually happens because they don't have a balance in retained earnings. They have no more profits to send out, but they still want to keep the stockholder happy. It's not that these are never taxed. They're just not taxed when we receive. Here's how the IRS deals with it. They say, reduce your basis in your stock for these types of distributions. So let's say you purchased Apple stock for $10,000. In 2020, you receive a non-taxable distribution from Apple of $8,000. Well, you subtract that $8,000 from what you originally paid for the Apple stock, and this is considered its new, or you could call it the adjusted cost basis of the Apple stock, $2,000. So when you sell that Apple stock, And they say, well, how much did you pay for it? Well, I paid 10,000. Yeah, but you had to reduce the basis by 8,000 for that non-taxable distribution you received in 2020. So your real basis in the stock is $2,000. What if instead, and this will happen, you have your Apple stock with the basis of $10,000 and your 2020 non-taxable distribution, NTD, is $13,000. Here's what the corporation will do. They will say, and I'll show you this on the form, the first $10,000 goes in this non-taxable distribution category. The other $3,000 gets taxed as a long-term capital gain. So when a corporation pays out of the profit, out of retained earnings, it's an ordinary dividend. But sometimes they'll pay beyond the retained earnings out of additional paid-in capital. We reduce the basis in the stock to the point of our original basis. So the new basis, or adjusted, I don't like new, I'll just put adjusted cost, would be 10,000 minus 10,000, 0. So when you sell this Apple stock, when they ask you what's your basis, it's 0. And then this other 3,000 will be taxed this year as a long-term capital gain. Any questions? All right, so let's go to the 1099 DIV, which is the form that ordinary dividends are reported on, as well as our non-taxable and our long-term capital gain portion. So there it is. So 1099s are, what is required to be completed by the person paying certain amounts out to the taxpayer, and these are sent to the IRS, okay, and to the taxpayer. There's your total ordinary dividends. So any dividends paid out of the profits of the company will be in box 1A. Here's your non-dividend distribution. That's your non-taxable. That's in box 3. And then anything beyond basis, box 2A, total capital gain distribution. So this is reported to the taxpayer. And that's all you need to worry about on that form for our purposes, except for box 1B, which I want to talk about right now. Box 1B deals with, let me see if they're here, qualified dividends. Dividends paid out of the profits of the company are ordinary dividends. Some of the ordinary dividends may be considered qualified. And all that means is this part of the ordinary dividends are taxed at special rates, preferential rates. And that's based on your taxable income. And we saw that on page, I think it's 710. You see what percentage to use based on a person's taxable income. What makes an ordinary dividend qualified? It's paid by a domestic and certain foreign corporations, and the stock is held by the taxpayer for a certain length of time. We'll talk about that now. So that's what qualifies. Let me see. That's not what I wanted. over here. Now, what's this length of time? Qualified dividend, length of time. Back when you learned about dividends, we said there's 3 key dates. The date of declaration, that's the day the company says, we're going to pay a dividend. And then the date of record. And this was your ownership cutoff date. So if you owned the stock on the date of record, you received the dividend. The next day after the date of record is called the ex-dividend date. In order for a dividend to be qualified, the taxpayer must have owned the stock 60 days before and 60 days after the ex-dividend date. So if you bought it during that 121-day period, you won't have a qualified dividend. Buy it outside, you own it outside of that 121-day period, you're cool. You will have your dividend listed as qualified, and I'm running out of time. So I'm thinking I'm gonna check in with my people who were previously quarantined and now could come back to class, and hopefully we'll have a bigger class in here on Friday. But stay tuned. If we're not going to have people coming back on Friday, I think I'm just going to do a Zoom from my office. So I'll keep everybody posted. Wednesday, we don't have class because of the in-service. So just watch your email and announcements in Learn. Okay? Any questions for me, guys?
Yeah, Lori, are you gonna have the camera on this afternoon for the 211 class?
Yeah, I think I'm just gonna go home and Zoom. I'm just gonna
Okay.
do everything through my computer at home, so you won't even need to see the board. You'll see,
Okay.
we'll do some, you'll see my, right on the screen, everything right on your screen. You won't have to be dealing with lighting and all. Okay? Watch for an announcement about that Zoom link. Okay,
Thank you.
you bet. See you later.
What a day, huh? All right, so you're going to